Hello and welcome to the Strategy of the Week tutorial for 18th of October 2013. My name is Steve Chappell, the Director of Educational Services here at VectorVest. We are going to deal with a very important subject this week, and we are going to allow you to discover the power of RMA. RMA stands for Relative Moving Average. It is an indicator found in our suite of ProTrader technical analysis indicators, so it is part of the add-on tool. As such, we are providing a discount to the add-on product in the VectorVest views this evening. With that out of the way, let's get into discussing the importance of relative moving average, as it's really a novel spin on the traditional usage of moving averages. So the first thing that we need to revisit is what is, just a plain old simple moving average. It says here that a simple moving average is a simple or arithmetic moving average that is calculated by adding the closing price of the security for a number of time periods and then dividing this total by the number of time periods. For example, just to keep everything simple, if we're looking at a short term, say a 10-period simple moving average, and we're an end of day chartist, we're looking at the closing price for each and every one of the last 10 trading days. You just sum them up and divide by 10, and that provides the most recent data point. As we move to tomorrow's close, the oldest day drops off, the new data for the current day comes in, you re-add the 10 closing prices and divide by 10 again, you get the most recent data point. So it's just a sliding or moving window of 10 periods. And in this case, we were talking about days. Of course, it could be minutes. All right, so let's dig a little deeper. Traditionally, moving averages are used in combination, whether you know it or not, because even if you're analyzing price to a moving average, you're really comparing two moving averages. One of them just happens to be price, which is a moving average of 1. You're only looking at one singular data point. Typically, you're comparing the two data points one to another. So you're looking for a short-term moving average which uses a relatively small number of price bars, to be crossing a longer-term moving average, which uses a relatively large number of price bars. For example, a 5-day crossing above a 10, or a 50 crossing a 200. In either case, a small number compared to a larger number of bars. And of course, this helps you pinpoint both potential entries and exits on a position. And so now, enter the relative moving average. A relative moving average still uses the combination of two moving averages. However, we're going to create a ratio of the fast to the slow. So the calculation is simple. We're dividing a fast moving average by a slow moving average. And then we're able to do this on an entire list of stocks. You could run this on the entire Australian share database. And if you think about it, that can yield some incredibly interesting results. For example, I'm going to start in the middle because it's the easiest one to understand, I think. If the RMA value is exactly 1 when you divide a fast by a slow, that means you're at the crossover point. 10 divided by 10, a $10 price point and a $10 value on a 50-day moving average, 10 divided by 10 is 1. RMA can then, however, look for overbought or oversold conditions. So if the RMA value exceeds 1, if it's greater than 1, that means that the fast moving average is greater than the slow. And we can look for the greatest disparity of that. So we can look for a situation, in the case of a 1 or price in a 50-day moving average, we can look for the stock whose price is furthest above the 50-day moving average, or in the case of the lowest RMA score, the stock whose price is furthest below the 50-day moving average. And if we know it's a great stock, it's got good RV, good RS, for example, and its price is well below its 50, what's likely to happen next, particularly at a market bottom? You guessed it. It's that old-term regression to the mean. That price is likely to move right back up towards that normal range of that 50-day moving average, and it's likely to do it very fast. It's like stretching a rubber band. If we're sorting several thousand stocks by this indicator, for example, finding the greatest disparity between those averages, you're pulling that moving average further and further apart. It's like stretching that rubber band further and further apart. When you let go, it's going to snap back even quicker. So there's some incredibly powerful things that can be done with this indicator. Let's jump right in the software and take a look. Here we are at the home page, and the first place we're going to stop this evening is the market timing graph, just to set up a few ideas and concepts for you. To do that, I'm going to go right up to the timing tab. I'm going to click on the market timing graph. And the first thing I want to deal with is the most recent market bottom, because if ever there's a time where you want to run this type of scan and really make some money fast, it's at a market bottom. Here we can clearly see after the fact that the market bottomed on the 25th of June. Now, here's the interesting thing. In VectorVest, you could have had a pretty good idea that this is coming. If I zoom in around this area, it's harder to pick up now than it was actually on the prior graph, but price is continuing to work its way lower. And this is the price of the VVC for Australia, so it's the arithmetic average price of all the stocks. It's continuing to work its way to lower lows, right? Well, the market timing indicator is actually beginning to work its way higher. We're at a value of 0.54 on the scaling here at this low, and when we get to this low, we're at a value of 0.56. That's a divergence and something to pay attention to, because as price began to rise quickly up off of this bottom, you could have said, hey, I've seen this before. I know that when price gets to an even lower point and the MTI is making higher lows in response to that, usually the market's going to rally strong from here, particularly when we're below a value of 0.6. Now, on top of that situation, were you to open up the software, if I just put on the green light buyer, for example, we received our first green light in the price column of the color guard on this very same day right here. So we've got the confidence of that classic divergence along with the evidence of a first green light in the price column of the color guard, and we're only a couple of days off the bottom. Perfect time to run something like an RMA, looking for the most oversold stock that has some value to it. Fact is, all these days right down here around that bottom, that's the sweet spot. Of course, the further away you get from the bottom, the less juicy it's going to be. Just stands to reason. Now, as the market continues to rally and the market matures, then you're better off going back more towards the traditional approach of just looking for moving average crossover and resumption of trend and things of that nature. That market tops, you just reverse the logic. So just remember these dates for now. We're going to go over into the Unisearch tool, describe the search parameters centered around RMA, and then run and show you some results. So I'm going to close out of the graph. We're going to go right up here to Unisearch. And of course, again, when you've purchased ProTrader or you try it out on a trial, for example, you'll have a ProTrader folder. In that folder, we have our RMA 1 in 50, and that's where we're going to begin. So here we're looking for a stock price, RMA, of a 1 in 50, and we're going to sort descending. So if we sort descending, that likely means the result at the top of the list will have a value greater than 1. The fast is greater than the slow. So in looking at a 1 in 50, price would be greater than the 50-day moving average. The higher the value, the greater the disparity, the further away from the 50 moving average it is. On the flip side, the lower the value, below 1, the further price would be below the 50-day moving average. So hopefully that makes sense. Now if I click in the value box here, of course you can set these up to your liking. We've got several different options in here for you for both the short and long-term moving averages. You can of course use simples, exponentials, or weighted. We're going to just use simples. They work just fine. You can then sort by the value. You can look for certain levels in the value. There's all kinds of different ways to use it, but we're going to keep things simple. We're just going to sort. But in this case, we're going to sort ascending, because remember, we're bottom fishing in this particular run. So we want price to be the furthest below the 50-day average. If I click on OK. Next, and very important things to add with this parameter, is some price and volume. If you don't, it's going to go out and return every single stock that's in the database and you're going to get stocks, typically in this case, that are right around 1 penny at the top of the list, because they're going to have the largest movement day over day. So we're going to go to our stocks, price volume, and let's just go ahead and put in our price actual greater than or equal to 5. I'm going to go right back through the steps and we'll add some average volume. So we go to stocks, price volume, average volume, greater than or equal to, and we're going to do 250,000. If we click in the next box, I'm going to filter out anything market related. So I'm going to go to stocks, filter by industry group, not equal to, selected industries, and put a check mark by the 3 of them, those being closed-end funds domestic, ETFs, and market indices themselves. If I click on OK, the final thing is let's give some positive reinforcement to the stocks that we're going to select from a fundamental perspective. And to do that, I'm going to add the last indicator here of relative value. I want to look for some long-term upside potential in these positions, even though we're going to capitalize on it short-term. Okay, and then in the operator value, we'll go greater than custom value of 1. Let's give them some upside long-term, and again, we're going to capitalize on it, hopefully, over the shorter term. So if we go back and run this, remember we got that first green light in the price column of the color guard off that June low on the 27th. So if we go back into June, we run it, here's our list of stocks. Now you can see the interesting thing here is we are again sorted by RMA, and it is going to spit the value out to you. So here you can see that it's got the lowest value on the RMA scaling, and the next stock on the list has the next lowest value. So again, the greatest and the next greatest disparity between price and the 50-day. In this case, price being below. So if we just quickly look at that on a graph, we'll right click and view stock graphs. Woo! Look at this stock. It got hammered, right? Now if we plot, this has a 40 moving average on it already. If we plot it to 50 and we go back to that June 27th time frame, there you have it. Look at the distance between price and the 50-day moving average. It's the largest in the database. What happened to the stock's price shortly thereafter, particularly since the market started to rally? It shot up like a bird. And so that's the phenomenon that we're trying to take advantage of at market bottoms. At market tops, you just flip the mentality. But you want to make sure that the relative values are less than 1 in your relative safeties and, any other indicator that you can align on your side. So let's see how these stocks have performed. I'm just going to highlight the top 10 here for us and then select quick test up here. Feel free to just quick test the top 10 at home. Here's our result. That's pretty stellar, is it not? 9 winners, 1 loser. The stocks as a basket went up almost 16%. That's 57% annualized. It's like shooting fish in a barrel. Really, really simple stuff. The next green light came in 4th of July. So if I go forward, click on the 4th, click OK, run the search. We'll quick test the top 10. 9 winners, 1 loser. The reality is over a few short days, this list tends to not change all that much. It can, but tends to be relatively similar. But certainly as you get a week and 2 weeks and so forth separated with your testing, you'll have much different lists in your basket of stocks. However, just goes to show you, those were the stocks that you wanted to pull from at that time, or certainly a list of great potential candidates you wanted to think about pulling from at a market bottom. Now, when a market matures, you want to switch out of this kind of mentality. If the market's been rallying for 4 to 6 weeks and you're still looking for stocks that are well below their 50-day moving average, we got problems, because at that stage the stock is low for a reason. It can be in a severe or substantial market decline that even some great stocks get beaten down. But when the market's rallying and they're still beaten down, then that's a whole different situation. So what you would lean towards then is perhaps moving into some shorter moving average combinations and even looking for just the crossover with the RMA. So RMA values of like 1.01, 1.02, or vice versa, to look for your entry points again that way. And so if we just bring things to recent times, and let's just take last Friday, for example, it would be a good time to start thinking anyway about switching your mentality as the Australian market has begun to move higher again, coming off that confirmed down call on just the 7th. And it was a strong day, the 11th. If we click on OK here and just manipulate our moving averages, let's move to a 5 and a 10. And we're going to sort of descending because we want to find that 5 as it's crossing above that 10, for example. So it's just another usage of RMA. Perhaps it'll make more sense when I run the search and we see the value. You see the value there of 1.01? That means they're nearly equivalent, but the short term is slightly greater than the long term, so it's the crossover. If we just take a look at the stocks that have crossed over in the last week, quick test them, boom, they're up 2.5%, market's up 0.5%. I mean, this tool is so versatile and can do it all. It's a wonderful tool to learn and use and just have as another indicator in your arsenal in the VectorVest family of indicators to use. I mean, it really is wonderful. We have used it quite extensively at technical analysis courses when we teach that. Wonderful, wonderful little oscillator that we just built here in-house at VectorVest. So I want to just thank everybody for tuning in. Hopefully you've discovered something new that you can incorporate into your own investing at home. Thanks for joining us, and we'll see you next week right here at VectorVest University.